Yes, ladies and gentlemen, I'm Jack Farmer. He's Raj Giri, and this is Practical Money. And have we got a good one for you? Raj, are you excited about this one?
I am, man, really excited. This is
Well,
uh this is one I've been waiting for.
I think a lot of people have been waiting for this one because this is your favorite investment. Before we get into it, though, I do want to make sure we say that this is not advice. This is just us chatting about stuff that we've done in the past as far as investment and money stuff goes. That's what this whole show is us just giving some thoughts on things we've done in the past financially. Please like, comment, share, subscribe, all that good stuff. For anyone who's listening to this, I'm rushing through this because I'm excited about this one, Raj. This is my favorite thing about investing. This is my favorite thing as well. But tell me, Raj, what is your favorite investment?
Well, I gotta say, I've been investing it's gonna be 25 years this year. I started in '98. During that time, I've done penny stocks, which I didn't do well in. Regular stocks, which have been good, bonds, real estate, REITs, alternative investing. But the one favorite stock, the one most consistent one, and it's the one I've been doing for forever. I'm still doing, and I recommend to all my friends and family. It is index funds, and I know that
Yes.
might be. I think people that already invest probably figured that was coming, but
Mm-hmm.
for those that don't or that haven't really dabbled into index funds, it's just been my favorite. In particular, the S&P 500 index funds.
I like that you mentioned the penny stocks. I think we've all done the thing where we buy, like, I could buy 100 of these for $1. And if it goes up 1 penny, I doubled my money.
Right.
Right. It doesn't usually pay off quite like that. But index funds, yes, they are. When we started talking about this, I remember I said to you, I'm not very flashy with most of my investing. I'm very boring. It's because most of what I do is index fund stuff. Not flashy, not that exciting. But Raj, I know there's some people who are watching this. You said people who invest probably already knew this was coming. But if you're new to investing, like a lot of our listeners and viewers are, what do you mean by an index fund exactly?
An index fund, or ETF, is basically like a basket of stocks that track the returns of a market index, like the S&P 500 index, as closely as possible. Wow, and one of the great things with either index funds or ETFs tracking the S&P 500 is that they have returns higher than 90% of hedge funds in the long term. And according to the S&P indices versus active scorecard, only about 11% of actively managed mutual funds outperformed the S&P 500 in the last 15 years.
One of the things I really like about it is the fact that because it is sort of a bundle of stocks, it, in my mind, protects me. If I have just invested into one company, let's say I'll use Tesla because it's going through some hard times. I've put all my money in Tesla and then it drops. Well, I've lost all this money. But if it's a bundle and one of those stocks drops, well, the other ones are still there to keep that investment strong in this case.
Right. Yeah, exactly. And, another thing I think a lot of people get confused with, and you mentioned Tesla, um, that wasn't in the S&P 500 10 years ago. It went in December of 2020. The company that Tesla replaced in the S&P 500 was called Apartment Investment and Management. If you yourself wanted to mimic the S&P 500, you'd have to first buy the 500 stocks in the S&P 500 and weigh them accordingly. Then when a new company comes in like Tesla, you would have to sell your apartment investment and management shares and then purchase Tesla. But if you own an S&P 500 index fund or ETF, that's automatically done for you. So you don't do anything. Automatically that stock's out, Tesla's in, you're automatically a little bit into Tesla, and you've done nothing. It's just simple, it's easy. And
Now, what if I'm someone who, I've got a big ego. I'll check out the internet and I'll read up on different companies. What if I'm someone who thinks that maybe I could invest better than one of these companies,
well,
or
I think
the S&P 500 to say?
and I think that happens a lot. When the market's doing well, because you could pretty much throw a dart and find something, and you're doing well. If you just look at this slide here from AEI, it shows how the S&P 500 index has performed against an average hedge fund. And now these average hedge funds are run by people who finance is their thing. That's what they went to school for. That's their job. and their job is to produce the best returns that they can for their clients. And if you look at here from 2011 to 2020, the S&P 500 has beaten an average hedge fund every year.
So what you're saying here for people who are looking at this is we've got the years in one column, then we got the average hedge fund in the next column, and that's the returns of the average hedge fund, as you say, created by people who they went to school to be as good at putting these things together as possible. That's what they were able to do. But in the third column, that S&P 500, that any old Tom, Dick, and Harry can go buy. I can go on there and get it right now, and it's doing better than what the average is doing for what the quote unquote experts are putting together.
Yeah, I mean, financial advisors, they often will have you, need to put in at least a $500,000. You have to have $500,000 in assets or $100,000, and they charge 1%. And chances are they're not going to beat these returns from the S&P 500.
So they're charging money, and you could still probably get the better return if you just go and buy the thing that's just out there for anyone to go invest in.
Right. Absolutely. Yeah, exactly. Yeah.
And so now I'm sure there are some people looking at this though and say that's the average though. What about the top hedge fund investors? They're probably mopping the floor with the S&P 500, right?
Yeah, right. No, that's not the case at all. And Warren Buffett, who is generally regarded as probably the greatest investor of our time, he in 2007 he bet a collection of hedge fund managers $1 million that they couldn't outperform an index fund, and Buffett won. The index fund outperformed the best hedge fund managers in the world, and Buffett won and donated his winnings to charity.
So a guy who, if memory serves, has tiptoed on being one of the wealthiest people on the planet Earth. He who knows a bit about investing. He's done it through investing. Even he's like, guys, just invest in these index funds.
Yeah.
I should say for transparency, I'd say probably like 2/3 of my investments go to index funds. Most of the other stuff I do is more when I want to like just have fun with something, or if I'm like, I think this company is going to do good, I'll put some money in there. But when looking into this, I'm sure that some people are going to see this video and they're going to say, I need to invest. This is the best thing. And they're going to come across a couple different phrases. And I know they're going to have the question, Raj. They're going to see the term index fund and they're going to see ETF. If I'm seeing this, if I'm Googling this, I'm seeing this, what do I need to know about the difference between these two?
Index funds and ETFs are actually really similar, but there are some differences. ETFs are traded more like stocks, so the price fluctuates throughout the day. An index fund is a type of mutual fund. It's a passive mutual fund. So the price of a share of any index fund adjusts after the market closes. ETFs generally don't have minimum investment amounts, while many index funds have minimum investment amounts, which can be in the thousands of dollars. And but the one advantage that index funds used to have is that you could auto invest in them and buy fractional shares. So if an index fund is $200 a share, you can purchase half of a share at $100. With most brokerages, you can't auto invest in ETFs, and you would have to buy the whole share. So if an ETF is $200 per share, you would have to buy at least one share at $200. If you wanted to buy two, it would have to be $400, and so on and so on. But now some brokerages like Robinhood and SoFi, which I use, allow you to buy fractional shares of ETFs and auto invest. And I actually auto invest a fixed amount into several ETFs each week on SoFi. And with mutual funds, you have two types. You have an active and a passively managed one. Active mutual funds have managers who select funds based on their analysis. And with that, you have a higher expense fee, a higher expense ratio. Whereas passive funds simply track an index. So and because of that, an expense ratio is going to be a lot lower. With index funds, highly diversified, have a low expense cost, while an active fund has an expense ratio of 1% to 2%, and index funds are generally under 0.1%. Usually they're around 0.3, 0.4, even as low as 0.2.
So is there an advantage to investing in the one that has a higher expense rate usually? in your experience?
Uh, no. TD Ameritrade has this chart from a video about index funds that looks at the difference the expense ratio can make, and it's pretty big. This example looks at an investor purchasing $50,000 each of two funds that both grow 7% per year for the next 30 years. The funds are similar except for the expense ratio, with Fund A being an actively managed fund with an expense ratio of 1.2%, while Fund B is an index fund with an expense ratio of 0.2%. And Fund A, with the higher expense ratio, would grow to about $270,000 over the next 30 years, while Fund B would grow close to $360,000. So that expense ratio made a difference of over $88,000. And when you add on top of that, that most active funds don't beat the passive funds. Most active funds don't beat an S&P 500 index fund. And then on top of that, you're paying expense fees. It's why it's why I stick with mostly index funds.
And they keep telling me it's my avocado toast that's costing me all the big bucks. It's really these little fees that's doing it, it seems.
Those fees will get you. You gotta read the fine print.
Raj, I said earlier about 2/3 of my investment goes to like the index funds and things like that. I always call they're not fun to buy, but they're pretty reliable. What about yourself? Do you have any feedback on sort of how you pick how much goes to things like the S&P 500?
Yeah. So myself personally, all of my accounts, I have a traditional IRA, a SEP IRA, a Roth IRA, and the reason why I have all three, I'll explain in another video. My wife has a SEP traditional and a Roth IRA. My kids have 529 accounts, and in my retirement accounts, I have FXAIX. I have it through Fidelity. All my retirement stuff's in Fidelity, and you can see it here. This particular fund started back in 2011. It's an S&P 500 index fund, and since 2011 up until when we're recording here is January 6th, it's up 178%. In my daughter's accounts, they have IVV, which is an ETF, not an index fund, so it trades like a stock. And that one started earlier. That one started back in 2000, and as of now, it's up 182%, and that's including, there were some bad years in that time. In 2001 to 2003, you had the .com burst. 2008, 2010, you had the financial crisis. So you had big drops those years, and still over time, and we auto invest every month. I actually do weekly, some of my ETFs, and you just see, if you just stick with it, don't even look, just automatically invest is what we do. And it just keeps paying off. And if you believe, which I do, that the market's going to keep going, over time, it's going to keep going up and up and up. Even though you're going to have your downturns, then that's why for me, it's made all the sense in the world.
Yeah, and that's, I think, such a big key there is everything will have ups and downs, but when you look at the overall arc, it continues to go up. And that's what makes it something that I think I always look at investing into. But these are all very well and good. They're all theoretical. And I'm sure a lot of people are looking back like, oh man, I wish I invested back in, 20 years ago. But that doesn't mean you can't start now, right? It's a little bit like fitness, right? Where you didn't start a year ago, but you can always start today. Same thing with investing. If you start now, it can still grow and you can still see things going up.
Right? Yeah. So I've been thinking about doing these videos since I sold Wrestling Inc. back in May. And yeah, in June, I was like, okay, I'm going to actually buy this index fund. And because there's so many videos, if you look out there on YouTube, they'll be like, hey, if you started this year, this is how much you would be at by now. And this is how much, if you started when you were 15, this is how much you'd have. I just figured it'd be cool to actually do a real example. And so I went and in my SoFi account, I bought VOO, which I own in some of my other accounts. But I went in, bought it from scratch, and then was going to do a weekly investment. And then stuff happened, but I did do it. I just never got to do the video. And so I went and bought VOO, and then after I bought it, I was going to make the video, never got time. And then, and I was like, okay, I'll just wait to do the auto weekly investing. And then after a few weeks, I'm like, okay, I'll just do it now. And then down the road, when I make the videos, I'll explain. So here we go. So June 16th, I put in $5,000.
Mm-hmm.
And then July 8th, I put in 500, and I was going to start the auto investing on that day. Didn't happen because it turned out I couldn't do the videos then either. And then finally I said, screw it, I'm going to start the weekly investing, and started from then on. So July 21st, July 28th, all the way up until January 5th, every week, just automatically buying $500 and going back. And you got to remember that the market's way down right now.
Mm-hmm.
And so obviously right now the returns aren't that great. It's returned 1.37%, $241 and $141 in dividends. But what I'm looking at here is where this will be in 1 year, in 3 years, in 5 years. And in the comment section on this video, I'm gonna I'll post updates, so we can keep track of it.
Yeah, and that's the thing too, is it's the long term, right? I think a lot of people, they get hung up on the, oh, well, it was $100 over a couple months, but it's the long term of it. And this is the thing where I always look at like people who have retired and have a lot of money. It's very rare that they're like, oh yeah, I got Social Security.
Yeah.
It's they've invested and they've put money away, and it's one of those things where it's been a few months, but it's $100, let's say. Then you do that for another year, and all that continues to compound and grow, and you keep putting into it. And that's how you retire with a lot of money. You start as soon as possible, which ideally everyone who's listening to this and watching this, if you haven't started, you say, I should go start now because it's so easy. I could go to a fidelity.com, for instance. And again, we're not sponsored. I happen to use them myself, so I say them. And you see just how easy it is. You can literally just type in the one you want to buy, hit buy, and you're done. And that's it.
Yeah. And with that VOO investment I started last June, if I started that 3 years earlier, where in June of 2019, I put in $5,000 and then invested about $2,000 a month after that, just looking at this calculator at dqydj.com, that investment would have been worth nearly $100,000 at the end of this past December, with an annualized return of 6.3%. And bear in mind, that's with the bad year for the market that we had last year, where the S&P 500 was down almost 20%. Now, I know that not everyone can invest $2,000 a month. So let's divide that last example by 10. So if we started with $500 in June of 2019 with a $200 monthly investment, that investment would have been worth nearly $10,000 at the end of this past December. So, gaining an annualized return again of 6.3%.
Right. And it's again, it's one of those things. You can obviously, again, if you put in a lot, you get a bigger return. But I think to anyone who hasn't started yet, just starting is such a big deal. And it does start to add up so much faster than you expect it to, especially now, because like you said, the returns haven't been that great, but that means now is a good time to get in because.
Well, and again, again, this isn't financial advice, and everyone's financial goals are different. If you're someone that's coming to retire soon and the markets doesn't look like it's correcting in the next couple of years, you probably don't want to be doing this. Or if you have debt, you don't want to be doing this. It's better to get rid of your debt first. So again, this is what I did once I was done got rid of all my debt, contributed to my Roth IRA, contributed to my 401k. That leftover money I have to invest, this is the one investment that makes the most sense to me.
Yes. And again, you could, if you wanted to do this one, you could literally just open up an account. Again, I just say Fidelity because that's the one I use the most. And you could just type in VOO, right, in the purchase.
Yeah, I can show you a quick example with Fidelity. And, whether you use Fidelity, TD Ameritrade, Charles Schwab, Vanguard, they're all going to be similar. So here I am logged into my Fidelity account, and you'll see that trade button on the upper left-hand corner, the trade link. So you go ahead and click that. And once you do that, from there, you'll see this trade window. And in this case, I'm buying the mutual fund FXAIX. You could do stocks. If you want to do VOO, you would pick stocks under the trade. Then you'll select which of your accounts to use. One of my accounts is called mutual funds. It's not the most imaginative name. Put in the symbol. Again, in this case, it's FXAIX. And it shows you the share price. It's $135.08. And again, as we mentioned earlier in the video, you don't have to you don't have to spend $135.08. So I'm clicking buy, and you just put in a dollar amount. You can do $50, $100, whatever. So in this case, I'm going to go ahead and do $100 and then hit preview order. So this brings you to the preview order screen, just shows you everything. You just confirm what you got, and then you just go ahead and click place order. And one of the things I mentioned earlier in this video is automatic investing. That VOO example that I was doing from SoFi, I'm automatically investing every week. Most people, don't do that. They'll do every month or, once a year or what have you. And in Fidelity, to do that, all you got to do is go to your, when you log in on the left-hand navigation, click automatic investments. And from there, you would just pick which automatic investment you want to do. In this case, I'm doing FXAIX again, the Fidelity 500 Index Fund, $100 a month. You could choose monthly, you could do quarterly, you could create a custom schedule, you can have it stop after a certain date, you could have no stop date, and then hit submit. And that's it. So it's really simple.
Super easy, super. We've said it before. My favorite, your favorite, not the trendiest, not the coolest. It's not going to be the thing that everyone's talking about around the water cooler, but historically speaking, Warren Buffett says it's great. I'm not going to argue with that guy. Index funds, ETFs, check them out. Raj, this has been very, very great.
Absolutely. My favorite investment. Check out the comment section below, and I'll keep that updated with how the VOO investment I started for these videos. We'll keep track of how it's doing.
And if you have any questions or concerns, let us know in the comment section. If we said something that you weren't sure what we meant, or had any questions regarding what we said, let us know in the comment section. Also, if you have any additional things you'd like us to talk about, let us know in the comment section. I think this was a great episode of Practical Money, Raj.
Yeah, no, again, it's one of the things I most enjoy talking about, and one of the things I always bring up to friends and family.
And so thank you to everyone who watched or listened. Make sure to hit the like button, the subscribe button, hit the little bell so you're notified of new episodes, and share it with your friends. Why don't you? Couldn't hurt. Thank you, and we'll see you guys for the next episode of Practical Money.